Hey friends, welcome. In this video I will follow up on what we started in the last video. So let's look at an important thing about when before you buy any stock. Let's look at how to screen a stock, both for fundamentals and technical. Things that I do look for in each stock is price by earnings ratio. Ideally I would like for price by earnings to be less than 15. In the last video we did cover about how to find out the price earnings, price to book ratios. You can look at the last video. So again, the screening parameters that I look for are price by earnings to be less than 15, price to book ideally to be less than 2. Again, depending on the industry segment. So let's keep it. Let's go over and then we will go back and cover the price to book and price earnings ratio for based on different sectors of the economy. Then the price to earnings ratio, price to book, current ratio, long-term debt to equity ratio should be ideally less than 0.5. Okay, so the current ratio or quick ratio is something the company's ability to pay the expenses and the debt holders with the cash on the balance sheet. Okay, so the current ratio will take into account the cash on the balance sheet and also the inventory. So then you will go back to the parameters like return on equity, return on invested capital, okay, net income growth rate, revenue growth rate, earnings per share growth rate, and then finally interest coverage ratio. Most of the out of all this, if you ask me what's the most important character that I look for is is return on invested capital. Return on invested capital is for every dollar amount or rupee amount the company invested into the business, what is the return they make on it, right? You just don't take it by itself. Take it with respect to compare it with respect to cost of capital, right? So not just the cost of capital, but weighted average cost of capital. So what's a weighted average cost of capital? So this is weighted average cost of capital is the estimation of the company's cost of capital to the equity and the debt holders on a weighted average basis, right? So say, for example, the company is already trading in the stock exchange, right? They want to raise some money. They want to invest in big money in capex. They have a new product, right? So they need to raise money. There are two routes to follow, right? Either they come up with a secondary offering, or they can go and raise their capital from the debt market. So to raise some money from the debt market, depending on their ratings given by the credit agency, to create the demand for the debt papers, they have to give a decent deal for the investors, so they can come and buy the debt papers. So the cost of capital is basically how much the company need to cover the interest to raise the money, so that the borrowed money can be invested into whatever the activity they are doing, and get a return that will beat the interest that they are paying out to the equity and debt holders. So if you look at all these things, these are the technical, fundamental, and the descriptive. So the descriptive is so for obvious reasons, it's just the market cap. If there's any earnings date coming up during the earnings time, the price movement of the stock will be explosive. So I try to stay away during the earnings. If you're already in the stock and you have some decent return, trim about half your holdings and let the rest run. So dividend yield, average volume and relative volume. If there is any news on the stock for any specific reasons, the relative volume will be really huge. Then when you monitor it, you can get into the explosive moves. But these are all for mostly traders. Again, what's the float of the stock? It depends on what's the number of shares outstanding compared to the float. The float for a mid cap stock, the mid and small cap stock, the float will be relatively low. So these are like how much is the float of the stock with respect to the outstanding shares, right? If it's like the float is over 25%, that means it's a lot of stock out there. So to make the stock move really 5-10%, you need a lot of money to make it move, right? But if it's the short is relatively low, the float is relatively low, any decent amount of money coming in, it will have a phenomenal move of the stock price. Okay. Again, stock price is the advertising mechanism. The price has to be decent for buyers or sellers, right? So to create the demand, the price need to move the different stages. For technical, you have a 20-day simple moving average, you have a 50-day to 200-day moving average, relative strength index, and pattern. Like for a selling and buying, there's a different patterns. Like you have the simple terms of horizontal support and resistance. Let's give you a graph of what I'm talking about here. So go back and click any of the stock, you will see what it means. So you can see the line, the blue line indicates that the support for the stock, right? So right here it's breached the support. So you see here this channel in between the two lines. The pink line is the trend line, right? So there's a horizontal resistance right there under support. The blue line support is down there. So you want to see different patterns like a wedge up. So you can see that the blue line is the bottom trend line. The trend line broke here, and then the pink line is the top trend line. So you can see it's forming, the price is going into a wedge and broke out of the wedge. This is like the orange line is a simple moving average, 50 moving average, and the 200 is this line, and 200 SMA simple moving average 20 is this light pink line. You can go to the Finways and you can look at all the chart patterns in yourself. You put in the chart pattern, triangle ascending. Again, for both the selling and buying, there are different patterns out there. You will be able to see it. Now the same thing if you want to do it on the screener. So right now here, go back and pick the stocks here. So go to the filters, and you can set all the filters you want. Moving average filters, moving average convergence, divergence, momentum, okay, Ichimoku cloud. Depending on the screen parameter that you want to use, you have a lot of things that you can choose from. I simply, like I told you in the last video, I simply keep it about the price about 200, price about 50, and if it's possibly between 20 and 50, I will go for it, and I will monitor the price action. So you want to invest in mid-cap stocks, set it over here. Again, this doesn't really make any difference. EBIT, goodwill is intangible assets. So always make sure that debt equity ratio is less than 0.5 and insider ownership. That's in Money Control in Economic Times, in a lot of articles out there, they always carry the information about insider trading. Again, the insider trading, you only come to know a little late. Even if it's a little late on this aspect, it will be a huge blow to your investment. So always monitor the price action. Like I told you, the price action will dictate everything. Always make sure that you're investing in a company, the basic parameters, the fundamentals are intact before you even invest in anything. The second comes the patterns, the mode of the company, and all that stuff. Okay, next we will come up with five. I will come up pick 5 stocks and I will analyze the balance sheet of the stock, the profit loss statement of the stock, the cash flow statement of the stock. Okay, we will go from there. Thank you guys.